afternoon. Time to have a look at markets. Shares in Asia were mostly lower, with Japan leading losses regionally and falling down 1%. Mainland Chinese markets do remain closed for the holidays and they will reopen on Friday. European stocks, though, are sharply lower as U.S. Treasury yields spiked, with inflation concerns continuing to weigh on global markets. The benchmark U.S. 10-year Treasury yield surging back above 1.5%, briefly notching a 3.5-month high as investor jitters over the potential for persistent higher inflation endured. The jump in bond yields has caused investors to flee highly valued tech stocks in the U.S. as higher rates make their future profits less attractive. To talk to us about a lot of the stuff that is playing out globally, as well as some of our local events and company news, we are joined by Michael Treherne from Investec Asset Management. Michael, thank you so much for your time. I mean, given what I've just read, and of course these investor jitters around inflation, how's our JSE and local markets looking?
Yeah, afternoon, Nastasia. JSE, after having a green day yesterday, is now down 1.6%. And that's following, like you could see behind you, most global markets are in the red today. US futures are also looking to open in the red later this afternoon. So it looks like a general bearish day. Chinese property market still weighing on markets, and then US politicians behaving badly, I suppose, is the other reason for issues. We're not sure what's going to happen with the US and their debt ceiling.
Right. Any company news that caught your attention?
It's been rather quiet at the moment on the company front.
So let's talk about this inflation fears. I mean, if you read various commentary, whether it was from the Financial Times or Bloomberg, it almost seemed as though when it comes to the inflation debate, people were split as to whether to believe that inflation was transitory. And this we're talking about 3 months ago. And it's quite interesting how the narrative has changed over the past few months. Those who did not believe the Fed are, I guess, tapping themselves on the back, thinking they were right. Where were you in that debate? Did you believe that in terms of the Fed that inflation was transitory, or were you sitting with the other camp?
Well, I think it depends on the time frame that you're attaching to this. I think everything in life is transitory, but from the Fed's perspective, they're still holding to that narrative, and I think you have to give it at least a year to see where you sit. There's no doubt that in the short term there's price pressures from energy prices spiking, and supply constraints. And if you have a look at the Northern Hemisphere, those problems are particularly bad going into the festive season and into their winter. You've got natural gas prices at all-time highs. You've got their ports looking very, very clogged at the moment. And you've got retailers saying that if you don't buy your Christmas gifts now, you might not have gifts under the tree in December. So there's no doubt that that's going to push up prices in the short term. But where are we in a year's time when the global supply chain normalizes? And I would sit in a camp that says we probably go back to a fairly low inflation environment. But time will see. I don't think we go back to zero inflation, but I think it's not going to be as high as it is now.
Right. Locally, when we look at some of the property companies, we've had news from Equitas Property Fund, Sirius Real Estate. Last week, one of the other property companies spoke about their vision for the retail industry. And I'm curious to know what your sentiments are towards local property stocks, especially those exposed to retail and the office sector.
Yeah, so at Investec, we generally don't buy property stocks, and that's because most of our clients already own their own houses, and it's a significant part of their balance sheet. So they've got more than enough exposure to property. There's no need to add it. Looking at the property sector from a high level, though, your big companies are down 50% over the last 3 years, but they've recovered since the COVID slump, most of them up 50 to 100%, which is probably in line with the overall market. Looking forward, what do you see happening? I think there's still a lot of pain to come. Many of these property companies probably have too much debt on their books, which makes them brittle. And then, like you say, office and retail, those are two areas where the economy is hurting at the moment, where we've got far too much office space. And our retailers have been struggling due to different lockdown restrictions. So I think I don't think they're going to go out of business, but I think that in terms of their share prices, they're going to be very, very volatile while they transition their business models and their balance sheets to normalize to these COVID times.
Right. So when it comes to what happened recently with Facebook and, the attention around Facebook and also, I suppose, the attention around other social media companies, our analyst yesterday who was on the show said, Facebook looking very attractive right now. When it comes to U.S. tech stocks, are you guys increasing your position right now? How are you feeling towards them? Do you agree that, the likes of Facebook, Google, etc., are attractive at these levels?
Yeah, so Facebook's a fairly unique situation. There's always been a dark cloud hanging over them because it's a company everyone loves to hate. And because of that, its valuation is generally a lot lower than its peer tech companies. Because of that, its share price has done really, really well because it continues to deliver very good results off a fairly low multiple. So Facebook looks very attractive at these levels. At Vestac, we've been heavily invested in tech stocks since 2012 or even before that. And we'll continue to be heavily invested in tech stocks. Only the last few years has more than half the planet had access to internet. That's even before you start looking at things like big data and everything else that comes with technology. So I think we're still in a very early phase of the technology boom, and it's the one sector that you want to be in because it's going to be the fastest growing across the world.
Before I let you go, end of the week we have the U.S. jobs numbers, the jobs report coming out. And how important is that for you, especially in understanding where the U.S. economy is going?
Yeah, that number fluctuates in its importance. During COVID, it was a hugely important number. As things start to normalize, its importance drops. I'd say this week that jobs number is probably going to be overshadowed by what happens in the US Congress. At the moment, the market's basically sole focus is what's going to happen with the debt ceiling and the infrastructure bills that they're trying to pass. So yes, it's important to a degree, but I think this week or this month, the number is going to be less important. Obviously, if it's very far away from expectations, that will have ramifications for stock prices. But if it's in the ballpark, I think most people are going to ignore it.
All right, Michael, thank you so much for your time. That is Michael Treherne from Vestac Asset Management. We're going to take a quick break, and when we come back, we'll have more news.